In today's high interest rate environment, most investors are walking away from deals just because they don't pencil out. According to CB Richard Ellis, transaction volume is down 43% from its peak, but there's still deals being made in this marketplace, and sellers have woken up and are willing to be collaborators and be willing to be creative to make deals happen. But if I told you could get seller financing, even when the seller still has a mortgage on the property, and that doing so could drop your down payment, cut your interest rate, and juice your return on investment by 100%. That's exactly what I'm going to break down in this video. But before I do that, why am I even qualified to talk about this? My name is Matt Drouin. I am a commercial real estate investor. I've been an active real estate investor for almost 20 years, transitioned to commercial from small multifamily residential about 7 years ago. And I love creative financing, and it's very, very prevalent in the commercial transaction space. And this is something that I've mastered, and I want to share with you on how you can make more deals get done this year than your competitors. So here's the brutal truth. Deals are harder than ever to make work. Interest rates are up, cap rates haven't adjusted enough, and sellers are living in 2021 pricing mode until recently. But now sellers are finally waking up. They know the party's over, and they're open to creative deal structuring than at any point in the last 10 years. In fact, I'm seeing killer creative deals get done in this market like I've never seen before. And you have to have your eyes open to using new tools to negotiate and getting transactions won in your favor. And if you can position yourself not as a lowball buyer, because you've been probably making offers out there where the delta between where you need to buy the property and where the property's pricing expectation is probably not even 100,000, it's probably several six figures or even seven figures, you can be position yourself as a collaborator and problem solver, and you'll win deals that nobody else can, just like myself and my clients have within the past 12 months. So here's the secret to getting seller financing even with an existing mortgage. Now, most people think seller financing only works if the property is owned free and clear. Not true. You can absolutely structure a deal where the seller takes back a second mortgage, even if they still have a first mortgage from the bank. And that's what I'm going to detail exactly how to do this and what things to watch out for and how to negotiate so that you don't negotiate a deal with a seller that even if it's acceptable to the seller, is not going to be okay with a bank. And in some cases, you can even replace the bank altogether and have the seller carry the entire note. I'm going to detail this later on in my 3 offer negotiation strategy. I'm going to detail with you exactly how I do this step by step when I'm negotiating on real estate transactions. So I've done both. I've done seller second, I've done seller first. The key is this, is that you need to know how to structure the offer and how to communicate it and making sure that it's actually bank compliant. So I never submit just one offer. I always submit 3. And when I'm going and reviewing deals and underwriting with my actual clients, when I'm advising them, we're always going to be doing a 3 offer scenario. And this is the exact framework that I use. And offer number 1 is going to be the traditional cash deal with bank financing. This is going to be the lowest price. This is going to be the actual price you're going to need to buy the property at in today's higher interest rate environment to actually make a deal that pencils. Offer number 2 is going to be bank financing, but also marrying that with a small seller carried second mortgage, which is going to be anywhere between 10 to 20% of the actual transaction price. I'm going to go later on at how to actually know whether the bank or what level the bank is actually comfortable with, and the exact math you need to use in your underwriting to make sure you're not setting yourself up for failure when it comes to working with banks. And offer number 3 is the seller holds the first mortgage, okay? And this is utilizing the 5-5-5 rule. So generally it's going to be our offer. Now this is not going to be where we land. This is going to be where we start the negotiation. It's going to be first position mortgage, interest only at 5%, 5-year term, and 5% down. And that's going to give the highest price of these 3 offer scenarios. Why do I do this? Because it gives the seller a choice. And each option solves different problems: certainty, speed, and price. It also positions me as someone who understands finance and wants to collaborate, not just negotiate. And also, when you're integrating seller financing into a deal, you're actually helping the seller by deferring their capital gains as well, because you can structure it as an installment sale so that you can actually reduce the seller's tax liability when they close a deal with you. So now we're going to go on to risk mitigation and lender relationships. Now here's a caveat. When you're structuring deals with secondary seller financing, you need to, number 1, have 3 to 4 local banks in your corner and ask them upfront if they allow subordinate financing. Some banks completely are just not okay with it, and that's okay. There's going to be banks that are very, very conservative and risk adverse that don't want to do that. You may be able to use them as your offer number one scenario where they're going to be able to offer the best terms when you're doing a cash deal. But there's going to be one or two community banks in your community that's going to allow you to do subordinate financing, which means that a seller's second is subordinated in the capital stack to the actual bank's first mortgage. And then number two, always run your numbers to maintain at least a 1.2 to 1.25 times DSCR, debt service coverage ratio. That's the total annual net operating income divided by the debt service, okay? So you can put together a deal that's 100% financing where you're bringing no money to the deal, but the annual debt service is just too high for most banks to be okay with that. And remember, banks are regulated by the Federal Reserve. This is not something that banks can go cowboy and do whatever they want, okay? So there is going to be, most banks require a debt service coverage ratio of either 1.2 to 1.25. And then going back to talking to the 3 to 4 local community banks and establish that relationship up front, remember, you want to have coffee or lunch with this bank or loan officer early on so you can put a face to the name. You can tell your story as a real estate investor so that when you do request a term sheet, you have a rapport already built there. So you're not just a cold contact a bank loan officer on a deal. And I've tried doing that before and I never get any term sheets, right? He's like, I don't know this guy, okay? So you want to put the work in up front, and getting those contacts from referrals of other commercial real estate investors in your market is the best way. So warm introduction to those contacts. But also, things change with community banks. One community bank that was okay with secondary financing might not be okay with it 6 months later. Things are very ever-changing in the banking landscape. That's the reason why you want to have 3 or 4 of these relationships set up front. So banks that allow a seller second don't care as much about the second mortgage itself. They care about the total cash flow in the property when you add in that additional debt service of the second mortgage. So as long as your deal pencils with the extra note, then you're usually golden. So why is this important? Okay, so a lower down payment means that you actually have to bring less capital to the table. So it's going to make your capital raise easier when you're raising the capital for the deal. You're going to get a below market interest rate, which is going to allow you to have better cash flow on the deal. You're going to have fewer partners because of you having to raise less capital. And you're going to have better investor returns, which means a faster capital raise. Okay, I'm going to go into further detail on a live deal that I'm working with on a client right now where the seller accepted taking back a small second mortgage in the property. I'm going to show you using my financial modeling spreadsheet what that does to the actual cash flow in the property and also the cash and cash rate of return, which you're going to know with crystal clear clarity why this actually makes it easier for capital raising purposes. The best thing here is that when you are using debt and private money lenders for your equity and down payment, you don't have to give up equity in the deal. And that's how you grow real wealth in your properties, okay? If you can own 100% of each deal that you do, you don't have to do that many deals, right? Because each and every deal that you do is going to be that much more financially impactful. So now we're going to go into the actual scenario that I was talking about early on as to how I helped a client of mine negotiate a deal with seller financing. Okay, so one, the first offer we did was a lower offer. I'm not sure exactly what it was, but it was the lowest offer of the 3, which is a straight cash deal. I get bank financing, and then you, Mr. Seller, Mrs. Seller, get cash at closing, okay? Offer number 2 was the seller second finance, where we asked them to hold a small second mortgage of $300,000 in a deal. And then the third one was 100% seller financing, first position mortgage using the 555 rule, 5% down, 5% interest for a term of 5 years. All right, so they couldn't do that because they had a mortgage on the property. All right, so this is what you're going to run into a lot. A lot of people, a lot of these internet gurus talk about, I just do seller financing in every single deal that I do. Have the seller hold a first position mortgage. Well, that's not always going to be the case. Most properties are levered to some extent, unless the seller has a very, very small first position mortgage balance on there that's going to get taken out with a down payment and they can hold a first position mortgage. Usually not going to be an option. So that option number 3 was the red herring. The seller didn't respond to that one, okay, because they couldn't. So we proposed hold a $300,000 mortgage subordinate to the first position mortgage at 5% interest only for a period of 5 years. And that's what we ended up negotiating too. All right, so on this financial modeling spreadsheet, this is actually available in my store. I'll put a link at it in the description below. You can actually purchase this, I believe, along with a bunch of other trainings on how to help you land your first commercial deal for $29. It's a 14-part training, includes the spreadsheet and also the training on how to use the spreadsheet as well. So this is what I'm talking about when juicing the actual yield. So this is the deal that we negotiated here. I plugged in the owner's goals. The bank financing we have is a 25-year loan. This one here, we put in a 0 amortization because that helps us calculate the interest-only payment on $300,000. And if you look right here, based upon the cash-on-cash rate of return is 22%. Now, let's think about what this does when we don't use that, right? Now remember, I told you that using this technique will allow you to increase your cash-on-cash rate of return or return on investment by 100%. So when we don't have the seller financing, it's about a 9.9% cash-on-cash rate of return, which is fine and actually really good for a deal. But when it comes to actually raising the capital, and the framework that I use is let's find private money lenders, people that are friends, family, professional contacts, people in your sphere of influence that you can borrow the down payment money from and use that as your down payment for these deals. So when we go on this, all right, so at $0 seller financing at 9.93%, we really can't offer that much out in terms of a return on investment to our private money lenders, right? It's like, well, I could stick the money into a CD or money market account and get a risk-free rate of return that's around 4 and 5%. 9-10% really isn't doing it for me. But look what happens when we actually increase this, right, to what we negotiated in this deal, 22%. So now I can offer out a 12% rate of return or fixed interest payment on the actual property, so that is a lot more enticing. And who wouldn't want 12% that's backed by real estate with a credible operator that they know, like, and trust? And also, look at this. It allows us to decrease the down payment to $115,000. So you don't have to raise $400,000 for this deal. You can raise a little bit of $100,000. And if you break this up around, let's say 1 to 4 investors, that makes a much easier capital raise. So if you could think about it, who has a self-directed IRA where they have $25,000 sitting in it, or an IRA that could be converted to a self-directed IRA where a 12% rate of return that's guaranteed by you is better than shark sticking an eye, right? So now what we're going to do here is we're going to look at the debt service coverage ratio, debt coverage ratio on here. This was very important, and the reason why we asked specifically for $300,000 in seller secondary financing, because we wanted to make sure that if you did this at the $500,000, I mean, this wouldn't even work on this deal, but the DSCR goes down to 1.15 and no bank is going to touch that. There are banks that are going to be okay with secondary financing as long as the total debt stack will help the deal achieve a DSCR of 1.2 or 1.25. So this one being 1.25, belt and suspenders, we just want to make sure they were going to be able to find a home for this deal. And we did with this deal. We shopped this package around to a few different banks. We had one that was a local community bank. They loved it. And we are in the process of getting the financing on this for our clients. Okay. So now the next thing we're going to do is we are going to go and look at what this does from a before tax cash flow standpoint. In this video, we're talking about having multiple entrance strategies with having a 3 offer scenario, but you still want to make sure, regardless of how killer creative a deal is, however good the cash on cash rate of return is, whether it's 22% or whether it's 50%, you want to make sure that you have an equity spread and an ability to force the appreciation of the property that's going to allow you to refinance the property, lever it back up, and pay all your people back in the timeline that you promise. So what we're going to do on this is we have a terminal valuation based upon our increase in net operating income of this property of $2.3 million. So we go to 2.314145. You can see in this cell right here, multiply that by 0.75 for a 75% loan to value scenario. Being conservative here, we might be able to get 80% of that at that time period, but we may not be, okay? So we have $1.7 million in loan proceeds, and then we're going to subtract that from 1.152. So subtract that from 1.152143. So we get cash out proceeds of $583,000, which is going to be more than enough to take out your seller second of $300,000 and pay back your private money lenders their $115,000 on the deal, okay? So here's the wrap up. Listen, creative financing isn't just a nice to have, it's a competitive advantage in a very, very tight market. And the reason why you want to master these skills right now is because this is where killer deals are happening. When everything is gunked up and nothing seems to be working based upon higher interest rates. You may pay higher interest rates right now, but when interest rates normalize and come, like, let's say down to lower 6% range, then you are going to be on top and you're going to have site control of that property and ultimate control over it, so you can take advantage of it at that point in time. If you wait on the sidelines like everybody else is doing right now, then you're going to miss out on all of these opportunities to not only structure creative finance deals where you put less money down and have to raise less capital, but also you're going to not be able to build out the deal infrastructure that you need to do in order to line up your second, third, fourth, and fifth deal that will happen in rapid succession to doing your first larger commercial deal. So if you want to stand out to sellers and avoid competing for overpriced garbage on LoopNet, use this strategy and bring 3 offers to every negotiation. This market rewards flexibility and creativity, and not the same old cash offers everyone else is throwing out there. So if this was helpful, please drop a like or let me know what your thoughts are below. If there's anything that you think that could be improved or an additional insight that could be helpful to others, please drop it below. I appreciate the feedback. And also, if you are interested in learning how to scale into doing larger commercial real estate deals without having to do the headaches of syndications, without having your own capital as a bottleneck, this is my business. I am a coach or advisor, whatever you want to call it, that helps experienced residential investors scale into doing their first larger deal without having their own capital as a bottleneck, and being able to repeat that and doing it in a system so that you're able to repeat that and scale it and take this thing to the moon. So be sure to check out to book in a call and a link down below in the YouTube description, and I'll see you in the next video.